AP, New York. In a continued effort to reduce inflation by making borrowing more expensive, the Federal Reserve increased its benchmark rate by 0.25% on Wednesday, making it the highest level in 15 years. Loans for homes, cars, and other purchases would probably become even more expensive as a result of the rate increase. However, you'll probably get a little bit higher interest if you have money to save. The Fed's most recent rate increase is less than its December half-point rate hike and its 4 prior three-quarter-point increases from earlier in the year. The slowdown is due to reducing inflation, which is still high, and what appears to be a cooling in some areas of the economy. What you should know is what is causing the rate to increase. The quick response is inflation. Consumer inflation in the U.S. over the previous year has been measured at 6.5%, which is still uncomfortably high but represents a sixth consecutive month of decline. The Fed wants to reduce consumer spending, which will eventually cool the economy and drive down prices by diminishing demand for homes, vehicles, and other products and services. Fed Chair Jerome Powell has already admitted that swiftly hiking rates will cause some pain for individuals, but that it is vital to do so in order to combat high inflation. Who are the most affected consumers? Credit analyst Matt Schultz of LendingTree said, "It's already been a really tough year for those with credit card debt, and it's only going to get worse." The increase's immediate nature, which impacts both current balances and future purchases, is difficult. However, Scott Hoyt, a Moody's Analytics analyst, pointed out that although they have recently increased, household debt payments as a percentage of income still remain low. As a result, many households may not immediately feel the effects of rising borrowing costs. What effect will this have on credit card rates? According to Bankrate.com, credit card borrowing rates had already risen to their highest point since 1996, before the Fed's most recent action, and they are certain to keep rising. Even though the majority of people currently have jobs and rising earnings, they can already see storm clouds forming in the distance, according to Nationwide senior economist Ben Ayers. The economy is really at a turning point at this point. 0% loans advertised as "buy now, pay later" have grown in popularity among customers as rates have gone up. However, these businesses' longer-term loans with more than 4 installments are subject to the same increasing borrowing rates as credit cards. The increasing interest rates are already having an impact on the balances of those whose credit scores prevent them from being approved for low-rate credit cards. Rates on home equity lines of credit and other types of variable interest loans will often rise in tandem with Fed rate hikes within 1 or 2 billing cycles. This is so because those rates are partly based on the prime rate of banks, which tracks the Fed's. Who are the affected savings? The rising yields on certificates of deposit, CDs, and high-yield savings accounts have brought them to levels unseen since 2009, thus families may desire to increase savings if at all possible. Bonds and other fixed-income assets now offer higher returns. In general, banks seek to take advantage of a climate with higher rates to increase their profits by charging borrowers higher rates without necessarily providing savers with greater rates. Does this have an effect on home ownership? According to a report released last week by mortgage buyer Freddie Mac, the benchmark 30-year mortgage's average rate dropped from 6.15% to 6.13%. The typical rate was substantially lower a year earlier, at 3.55%. As a result, the interest rate on a typical house loan is still about twice as expensive as it was a year ago. The benchmark rate set by the Fed doesn't always move in lockstep with mortgage rates. Instead, they frequently follow the yield on 10-year Treasury notes. If I'm still looking to buy, will it be easier to find a house? There are probably more possibilities available to you now if you're financially able to buy a property. If I want to buy a car, what do I do? Automakers are producing more vehicles now that shortages of computer chips and other components are less severe. Many are even lowering their pricing or providing small discounts. But a large portion of the monthly payment savings have been lost due to increased loan rates and declining trade-in values for old cars. According to Edmunds data, the average new car loan has increased from 4.5% to 6.9% since the Fed started raising rates in March. Loans for used cars have increased by 2.5 percentage points to 10.6%. For both new and used cars, the typical loan term is 70 months, or over 6 years. According to Edmunds, the average monthly payment for a new car has increased from $71 to $728 since March. It has increased by just $3 a month to $546 for used cars. According to Drury, the current cost of financing a new car, which has an average price of $48,516 as of December, includes $8,769 in interest. That alone will drive many people away from the car industry. How have rate increases affected crypto? Since the Fed started hiking interest rates, the value of cryptocurrencies like Bitcoin has decreased. Many once highly valued technology stocks have as well. Because their returns have grown, higher rates make secure assets like treasury bonds more appealing to investors. As a result, risky investments like tech stocks and cryptocurrency become less alluring. However, issues unrelated to economic policy still plague Bitcoin. Investors' faith in cryptocurrencies has been shaken by the failure of three significant organizations, most recently the well-known FTX exchange. What about my job? The labor market is still comparatively strong, according to Nick Bunker, Director of Economic Research at JobSite Indeed. Things are normalizing and slowing down. The Fed believes the job market is too strong, which is one of the reasons it keeps raising rates. Some economists contend that job losses could reduce inflation and that a tight labor market drives wage increases. Even while layoffs are currently at an all-time low, it's also possible that there won't be as many openings for employment in the near future. The most of the hikes, in my opinion, are behind us, added Bunker. However, there's a chance that the labor market will worsen for some people, so people should be on the lookout for a sustained slowdown. Affected student loans from this? That being said, as part of an emergency measure put in place early in the pandemic, payments on federal student loans are frozen with no interest until summer 2023. Additionally, President Joe Biden promised loan forgiveness of up to $20,000 for Pell Grant recipients and $10,000 for most borrowers, a measure that is currently being contested in court. Are the rate hikes likely to be resolved? The likelihood of rates decreasing anytime soon is fading. Even by the end of the year, inflation will likely still be too high for the Fed, according to Nationwide's heirs. We anticipate that they won't start lowering rates until next year. Thank you for listening and don't forget to subscribe.